Hi, my name is Gary Sutherland. I am the CEO of North American Professional Liability Insurance Agency, otherwise known as NAPLIA in the industry. We work with a number of national associations in the investment advisors space. We work with both plan sponsor, ERISA attorneys, and investment advisors. And what we do is we offer information regarding insurance products and why they're important to you. Today's presentation is going to be based on why, as a plan sponsor, do I need to understand and know what my insurances are and what maybe my advisor has for insurance. So the first part we're going to talk about is fiduciary insurance, probably the biggest word in the industry over the last few years. Everything is a fiduciary today. First party fiduciary is the insurance that a plan sponsor buys and has to protect them, plan committee members, trustee, owners of the plan, from suit related to both 401k plans and any other health and welfare plan that you may have. I think a lot of people don't realize that under ERISA, things like dental and health insurance and long-term disability and short-term disability are all guided by ERISA, just like the 401k. So first-party fiduciary insurance is bought by the plan, and it covers all of the fiduciaries of the plan and also covers what's called a functional fiduciary. So that might be an individual in your office that handles plan benefits, oftentimes a human resource person, who may not understand that they're fiduciary, but under ERISA, as a functional fiduciary, they are. Under ERISA, first-party fiduciary potentially exposes their personal assets, and that's the biggest concern about ERISA, that as a plan owner, plan sponsor, trustee, you could be potentially liable with your own assets for an error or mistake made in handling a fiduciary plan. So first-party fiduciary insurance is very important. People ask, what limit should I buy? And generally speaking, for the small plans, you're probably going to buy $1 million in coverage. For a little larger plan, you're probably going to buy $5 million. You're never going to be able to buy as much insurance as the plan assets. The reality is that you're looking to cover mistakes made, and it's unlikely that you're going to have a mistake completely made on the whole plan. So you want that protection. In addition to that, in the event of an issue that would arise regarding an ERISA benefit, you want to be able to speak to a knowledgeable ERISA attorney rather than sort of calling up the yellow pages or talking to your corporate attorney. You're now calling an insurance company who specializes in handling ERISA-related claims, and you're going to get the best advice. Fiduciary insurance, first party, is not an expensive item. In fact, on our website, we rate plans from $1 million up to $50 million. And as an example, a $50 million plan that buys $1 million worth of coverage, we're talking somewhere in the neighborhood of about $3,000 annually. So it's not an expensive item, and very important to offer some protections to you. In regards to fiduciary insurance, there's also what's called third-party fiduciary liability. And third party comes from your advisor, your TPA, or other investment advisors that work on your plan. And you want them to have third-party fiduciary insurance so that if they make a mistake, they have insurance that's going to indemnify you and the plan. You want to make sure that the investment advisor has a good track record and do all the due diligence that you normally do. But insurance should be a big component of what you're looking at. For example, under third-party fiduciary insurance, you'll find about 50% of the policies that we look at actually don't provide fiduciary coverage as a third party. So it's called an absolute exclusion. In addition to that, there are other modes of fiduciary coverage within policies, including silent. So there's no reference as to coverage, there's no exclusion as to coverage. The problem with silent coverage is, in the event of a claim, you don't want to be arguing that that was the intent of the policy. There's also what we call modified coverage for third-party fiduciary. And modified says that, well, we cover you under certain aspects of what you do and other parts we don't. For an example, if you're a plan sponsor that utilizes a 338 investment advisor, that's generally going to be not covered under a modified form. What we like to see our plan sponsors have, and what we recommend to those plan sponsors and the investment ERISA attorneys, are that they have affirmative fiduciary coverage. The policy spells out that they cover the third party for acts as a fiduciary to your plan. That's obviously the strongest policy and the one that we really recommend. Now, when we step away from third-party fiduciary is not an individual policy, but is rather part of what's called an errors and omission policy, sometimes referred to as professional liability and even malpractice insurance. So when you're dealing with an independent advisor to your plan and you're asking them about coverage, you're asking about that type of coverage. Now, you have to realize that it's no longer acceptable to just receive a certificate of insurance from your third party saying that I have coverage, it's a million with a $5,000 deductible. The problem with that is you don't understand or have any knowledge as to what it's actually covering. So it may be covering some aspects, but maybe excluding fiduciary, maybe modified, only covering certain aspects. So the only real way to understand whether your advisor has the correct coverage is to look at the policy and review all of the endorsements. Now, we work with plan sponsors on a regular basis to do that on their behalf because we understand that your expertise is not going to be in reading insurance contracts. So what we'll do is we'll review the policy, we'll make recommendation as to coverages, and we're often asked to be involved in the RFP process so that when plan sponsors are evaluating a number of advisors, we can at least give them advice and counsel on the insurance components. Recently, we participated in one where there are 4 advisors that submitted proposal to the plan sponsor. We reviewed the insurance components. 2 of them were eliminated right off the bat because they didn't have insurance. The next 2 both had affirmative E&O insurance. Then we looked at another type of insurance called ERISA bonding. And I'll go into a little bit more specifics later, but just to say that when we looked at the 2 advisors, we felt one clearly had a better coverage, and so our recommendation was, all things being the same, that we recommend that you go with the carrier that had the better coverage. Now, it's only one component of it. There's obviously a lot of other due diligence that you need to do as a plan sponsor and work with your ERISA attorney. When we talk about ERISA bonds, we're really talking about a policy that's designed to cover theft against the plan, the 401k assets. Under ERISA, under Section 412, all plan sponsors are required to have a bond in place. You disclose it on the 5500. It works like this. It is a percentage of, or 10% of your plan assets up to $500,000. If you have company stock, then it's up to $1 million. So if you have a $2 million plan asset account, then you're required to have insurance up to a plan sponsor, plan committee, trustee, or a functional fiduciary. Not designed to cover third-party acts. That's a separate bond. This is all first $200,000. And it's designed specifically to cover any potential theft by party acts. Now that's the minimum. You can have a higher ERISA bond, but in most cases, most plans buy the 10% coverage. It's very inexpensive. You can usually buy something under $500 annually. Oftentimes you can buy a 3-year policy, and again, it's not an expensive item. Now, if you're the investment advisor and you have discretionary authority of any kind over plan assets, including even being paid directly by the plan's funds, not going through an intermediate, then your investment advisor is also required to have what's called a investment ERISA bond. It works very similar to the first party ERISA bond, except that the investment advisor provides a list of all the plans that they have, all the assets under each plan, and then buys a blanket bond to cover all those plans. Each plan has an individual limit up to 10% of plan assets, or $1 million if there's company stock. So it works very much the same. Most investment advisors who answer the question, do I have discretionary authority, when they don't, often don't buy the investment ERISA bond. But Section 412 says that if you have any discretion, so that means if you have the ability to subtract a management fee directly from plan assets, then that's discretion, because you could potentially increase that fee that was agreed to from say 50 basis points to 100 basis points, and without the permission from the plan. If an advisor has no discretionary authority, not paid directly by plan funds, then they don't have a investment ERISA bond exposure. On the other side, if they're working with individuals within the company in non-ERISA, say other types of investments, you certainly want them to have an employee dishonesty policy to prevent them stealing non-401k funds. And that policy generally works as a blanket, but it's not specific to your company. If they have a $2 million employee dishonesty policy, then it'll pay up to $2 million for anyone that has loss, as opposed to the investment ERISA bond, which will pay 10% directly to you for plan losses. Now, when we're really talking about, again, why